All right, guys, I got a little of a new video for you. I wanted to talk about YieldBoost and I wanted to compare it to YieldMax and a little bit to, in my opinion, the only real competitor to date is Kurv. So let me take you through what I think YieldBoost is going to bring, what Kurv brings again as a reminder, and just see if YieldMax is king of the hill and what competition can do to straighten them up. Again, I see a few poor executions, and there's nothing like good, strong competition to maybe clean that up. Other than that, they have the broadest selection and they have the highest paying, no question. But let me give you my thoughts. I think you might be surprised and you may learn a thing or two. All right, let's jump in here. So first off, what does competition do to any market? Go look what AMD did to Intel at the consumer level. I grew up in IT when mainframes, when I first started as an engineer before I moved into say ultimately sales and sales management, business development. IBM was a dominant giant. They would hand out 3%, 4% improvement. And then slowly, these engineering heads of areas within IBM, both in their mainframe and their tape drives, their disk drives, yeah, they were a disk drive. Now we don't even think about it. Your mobile phone has storage. Now they've moved to electronic and solid state disk, but all through the cycle, throughout history, competition has given us consumers, and if you're in the corporate world, it's given corporations, a better opportunity. Just like now within NVIDIA pricing on their GPUs, they own that upper 15, 20% from a performance standpoint, and they price. That's why their earnings have been blowouts. But trust me, competition will help all the other companies that have to buy their high-end GPUs. So anyway, let me get into this. So I expect the best competition to date, all right, knowing the background of Granite Shares. So when I get to Granite, I'm going to teach you guys, I think, a few things there of why I think this fund can be equal or better than YieldMax. But again, they have to execute, right? So what are they bringing? Well, YieldMax, sorry, Granite Shares in their Yield Boost offering, they've applied for 25 new ETF funds. Well, first off, they're almost, the same. There are a few differences that YieldMax doesn't have. But YieldMax isn't going to own things that they own now because I'm going to tell you their second best competitor to YieldMax today, in my opinion, is Kurv. And I'll take you through and remind you, I interviewed the CEO and I talked with him a little before, even to really learn exactly what they're doing. And then he brought out a lot of it in the interview. But, those interviews move quickly and, it's hard to digest it all in one session for the average viewer. So I'll remind you. So on the 25 new funds, they're going to do synthetic options. Well, synthetic is no unique thing. It's been around for a long time. It just hadn't been around at the retail, right? Where did it start? Well, it started in high net worth individuals, 7 and 8 figure people who had large portfolios. Then the management fee was nowhere near as low as it is now. They were getting a lot of income to produce these great returns for wealthy people. Now it's available at the retail level, not without its issues. And I know it so well now from reporting on it the last 4 or 5 months. Not that you learn the nuances. I knew options. I was putting on my own synthetics over time. It just is one of the advantages they have. First off, they don't have to worry about getting assigned. Why? Because they're on the flex system, right? So that's a positive. You or I in the retail space have to worry about getting assigned. Secondly, it's economies of scale. So you guys know that, but some of the people watching this may not know that. So somebody said, "Well, Bruce, if you're so good at it, just go do it yourself." Well, it's kind of difficult when you got a $1,800 MSTR. I got to buy 100 shares just to do one contract, right? So they got 50 million, 100 million flowing in. And when they put on their synthetic, all they need is the collateral. So what are the components of a synthetic? Well, again, I've been doing what they call combo, and it's exactly the same thing. It's a synthetic. I buy a call, I sell a put, same strike price, same expiration date. Okay. So that's a bullish bet. On top of it, they are, and they call it a covered call strategy, but it's not a covered call. They're selling a weekly call, and it's a naked call. There is no underlying stock. They don't own any stock, but it's referred to as a covered call strategy because they're long the stock through the synthetics. Okay. There's nothing magical about the treasuries. The only reason the treasuries are there are to be the collateral for the options. So obviously, the definition in the SEC of an ETF is that you can't have more than 10% in any single stock. The idea is that an ETF is going to be 3 stocks, 5 stocks, 20 stocks, 100 stocks. And that's why they made the rule. So the only way to get around this rule when you have a single stock ETF like YieldMax has a ton, so does Kurv, but Kurv only has 6. But do they use synthetics? Absolutely. What's the difference, one could say? And I'm leading into Granite, trust me. Well, the difference is 2 differences. The difference, most people look at it, you greedy, greedy, greedy people, and I count myself as one of them. So I say that lovingly. You chase yield. We all do. Why do I want to go buy a fund that has a 20% yield when I can buy a fund that has a 100% yield? Well, there are sometimes reasons because I look at total return. I know some of you guys out there and are just saying, I don't care about that, Bruce. I look at ROI. If they're going to pay me 70% yield and I get enough yield in the next number of years, then I own it outright. Okay, but what do you own? What if the NAV is 80% reduced? You own an asset that's dribbling a drop of water, but when you bought it, it was giving you enough to fill a glass 10 times a day. So don't forget that NAV reduction does matter. So if you think it doesn't, you're only fooling yourself. Wait till there's a 30 or 20, 25% pullback in the market. And then you're going to say, well, I don't care as long as they keep paying me yield, right? The volatility goes up if the market. Yeah, that part's true. But remember, the yield is paid on the NAV price. If they're returning 100% yield, they base it on what is the price. And the other thing, and I'm going to go into Kurv here in a minute, and I'm not trying to defend Kurv. I don't own any Kurv right now. I think the fund is good. And if I was buying any of the funds that they had, I probably in certain instances would prefer the Kurv over the YieldMax, but I'm not. What am I in? I'm greedy, remember, like you guys. But I'm also not greedy unless I'm bullish on the underlying. So what am I bullish on? I'm bullish on BTC. So I have Coney, a little bit of YBIT. I'll tell you about that in a minute. And a lot of Misty, by far my biggest. Why? Because they're all BTC oriented. I'm bullish on BTC. You're not going to get 100% yield on Amazon or Apple or Google because they've already, the time to do that was 15 years ago when they were in their infancy. Now you might get that, and I'm very bullish on Tesla over time. All right. So there are certain instances that competitors don't exist. Granite is not going to have a problem being a competitor. Let me tell you, First off, what's the background of Granite? They're a bigger fund. There's 6.5 billion assets under management, and YieldMax is 4.5. So they're another they're 1.5 times the size. Does size matter? Well, in some things. And it doesn't mean bigger is better, right? So agreed. I mean, look at YieldMax. They came sort of out of nowhere, and they got Zega, and Zega's doing some stuff with Defiance, and Jay's obviously a bright options guy. Kind of sad though, because he's far enough along in his career and co-CEO of that company. I guarantee you, he's not doing the trading. I don't think some of these mistakes would happen if he was doing the trading. Um, and you guys all know, if you watch my videos, usually it's Misty, sometimes it's Coney, but they just dropped the ball. You know, they got one day to go and they got an 80% gain, and they let it ride, and then they lose 3 times all the money that they already captured. So it's frustrating to see that. I get it. They're not, you know, um, they're not predicting the stock market. They got a script and they do the script. All right, let me get into this. So Kurv has also, let me give you some, so it's a smaller fund with only 6 ETF. Let's go through Kurv, and then I'm going to take you through Granite. All right, here's Kurv as a reminder. Some of you didn't see this, okay? So out of 6 funds that Kurv has, every single one of them are in YieldMax. Call them a copycat, but Howard told me, Howard Chan, the CEO, in our interview, he said, Bruce, a lot of people think we're a copycat. We applied for some of these funds and got them prior to YieldMax even applying for them. We just chose, we weren't ready yet to go to market. And I know that to be true because Jay's talked about several interviews. They've been approved on some funds and still haven't launched them to this day. You know, remember when you apply and you get it, there's 90 days there. Well, what is all that thinking and planning and writing your prospectus and all the other stuff? That might take 3 months. So these things are 6 and 9 months in the work, and I could even be missing that. It might be a year. So let's go through these as a reminder. So when I compared the 6 previously, I had 3 wins by Kurv, 2 wins by YieldMax, and 1 tie. Since I plugged in the new prices, we now are 3 and 3 because that tie, 1%, YieldMax got ahead. So at least listen to these, right? So YieldMax 1, when you compare Amazon, is the underlying, AMZ to AMZP, okay? Somebody says, yeah, 36, would you rather have a 36% yield? I would, than an 11. But is that the whole story? No, it's not. What about the NAV drop? So on the YieldMax fund, they're up 2.7% on their NAV, and they got a 36. That's pretty cool, right? But guess what? This isn't too bad. They got an 11%, but they got a 16.45. So at least that's not as good. So if I'm going to do Amazon, I'm going to do AMZ over AMZP. Okay? No question there. But some people don't even like any NAV. It just eats at them, right? I'm more of a total return guy. All right. So what about Goop and GUI? What about Google? Yeah, what about it? It's down, right? So, and these don't line up perfectly, but there's enough months there that they do, and it does matter. So I got an 8 months here and 11 months. I had the same thing up here, a bunch of them, right? This one's a little bit closer, Microsoft, 8 and 10. This one's even further on TSLP and TSLY on Tesla. So what happened on Goop? Well, Kurv got a 9%, and as you'd expect, YieldMax being named Yield Maximum, right? Got a 22% return. But look at the NAV difference. That's a big difference, guys. 50, almost 16% gain and almost a 21% decline. I will take a 23.7% difference. I know you ROI guys say, yeah, but in 5 years. Well, don't do that. Anybody that shows me a spreadsheet and says, look over this is what happened last year, and in 4 years I'm going to be retired and I'm going to have 30,000 a month. That's BS, right? Do you know what the market's going to do? Well, why don't you just go buy an option on the market and put every penny you got in it, because you're going to make a lot more than buying these funds and letting them do it if you really know that, right? You don't, obviously. So that's my problem with trying to project out. Not saying that you can't do it. If you want to alter your behavior, I know a lot of very wealthy people that have a lot of money in these funds, including myself. And but I watch it. I'm ready right around the corner. I have some protection in place and I'm ready to change my path, right? You sort of take it while it's there. All right, so let's look at the next one. This one was won by Kurv also, 10%. So 60 to 16, oh my gosh, right? What's wrong with YieldMax? Well, let me explain the subtle differences in how YieldMax does their synthetics and how Kurv does their synthetics. They both have synthetics, okay? However, Kurv writes theirs out, their naked calls, they write them monthly, not weekly. Howard said to me, "Hey, I'm cheap, right? I don't want to incur 4 times the expenses, right? So in a market that's really volatile, just up 3%, down 2, you're better off with a weekly approach because you don't get as massively capped. You can get capped big time in a week. You can write out 5% out of the money weekly calls and have it run 15. We all experience that. Nobody likes that. But on that monthly basis, they're going and grabbing more income out of the way that unless it goes up 15, 15, 15, 15 all 4 weeks, they're going to do a better job than YieldMax is going to do. So there are pluses and minuses. That's why these vary. Otherwise, I mean, you really have to understand these funds. And when you start reporting them on them daily and just watching it, you really see where the rubber meets the road, right? You also see poor execution sometimes where they don't take something off. But in general, they do a good job. I'm not here to tell you it's a horrible fund at all. It's just frustrating to see some of those mistakes. So, and we all know what happened to Tesla. I did a forensic accounting on Tesla to understand it better, and because it's the only situation where the stock, okay, went down a lot and then went back up, and Tesla wasn't able to capture a lot on both sides, okay? So in some fairness, they're always going to do better dropping, right? A stock drops 60%, 70%. So they're going to get their weeklies. They're going to win their weeklies all the time, and they're going to lose on their synthetics, being long the stock. So it's going to be similar to the downdraft of the owning the underlying, but you're going to have a little bit of income offset, okay? So you're better, slightly better on crashing, if you will. When it comes back up, if it roars up and goes 15%, 18%, 17% every week and just massively takes off, you're going to get capped like crazy. It's exactly what happened in Tesla when you look at it, okay? So that can happen to any stock, okay? And so you got to understand when you want to be an active trader like I am. I don't know, a lot of you can. If you just want income and you park it in there, I try to tell you guys at least, think about going and buying a 2X or something. So you can actually capture that upside that's about to take place. Leave your money in the income. I'll even give you a scenario. Let's take a Bitcoin. Everybody loves Misty, right? So let's say that MicroStrategy continues and Bitcoin runs to 105. MicroStrategy goes to, I'll make up a number, 3,000. Okay. We all know then it's very vulnerable to a big pullback. May come back to 1,800. Can you imagine the downturn in MSTR from 3,000 to that. Now, some of you are going to say, great. Well, we don't have the inverse MSTR. We have an inverse dips. We have a fiat for coin, and we have a crash for Tesla. And those are okay, all right? But there are other ways to do it as well, right? Just buy a 2x bear or buy a 2. Now you're not going to get income on those, but you're not going to get capped. You have to remember, if you go and buy a dips on Nvidia and Nvidia just really drops, right? Let's say you're now bearish. It's gone on back up to 160 and you think it's going back to 100 or 80 and you buy dips. Okay, it can get capped on the way down exactly the same way. Now, they do buy a call way out there, but in the meantime, you're going to get capped every week along the way. All right, guys. So I can continue down these, right? So they were each 1-3. If you go through, YieldMax won Microsoft, YieldMax won Apple, and YieldMax won Amazon, right? I'm just giving you the underline. So while it was tied 3 each, YieldMax in its 3 wins achieved a total 27.1% more than the competition, than Kurv. But when Kurv won 3 wins, oops, but it's 3 wins, had a 44.7. So it had another, 80% greater total return in its 3 wins. So I'm just a proponent of total return, always have been. I get ROI, and if you lost the NAV, but you got all your money back, but they paid exactly the same that they always did when you first bought it, I too probably would say, NAV doesn't matter. But if the NAV's 20, okay, and the stock goes down to 8, and maybe it hasn't even split, then your yield on 8 is a lot lower if it's a certain yield than it is at 20. So you may have an asset producing income, but is it the same asset? No. So I don't think you can ignore total return. All right, I beat that up enough. Let's go back and see. Oh, and here's one more little thing, okay? Worth noting, because you know what I find a lot of people, they just want to jump on what everybody else is doing, right? And YieldMax is the hottest thing since sliced bread. Well, it may not be if the markets pull back 25%. I want to see what all the comments, probably I won't have any views, right? Any YouTuber that report, our views will go way down, but so be it. I'm making money because I'm active in these funds. My YouTube is minuscule in comparison. Okay. So what about ROC, return of capital? You guys understand what it is? I know some of you do, some of you don't. Well, let me give you just a little description, okay? When you get, and I know this is important to some of you, and I've seen the videos. Look, I see some of the same YouTubers out there saying, I don't care about taxes, just give me the money. Well, doesn't seem right to me. If you say, just give me the money, but the government's saying the same thing, just give me the money, right? So if you got 37%, I agree that it's more than nothing. If I give you $10 and say, hey, you owed me $2 because you borrowed it, you're like, oh, okay, well, I got the use of the money. And it's the same thing here. I mean, if I got 100,000 coming in, I got 1 million coming in a year in these distributions, and I owe 400,000, I still got 600,000. I get it. But why not maximize that? You're trying to maximize your yield. Why not maximize your net income, right? So, and I didn't even know this, guys. I was preparing this. I knew that sometimes there's ROC, return of capital. But the way I understood it was these funds go along distributing their income along the way. And then when they get near their fiscal year, and remember, they vary. I think YieldMax is in October 1, could be October 31. But fiscal years vary, but there's a rule that the SEC imposes on these income funds. And they say, hey, if you retain more than 90% of all the, more than 10% of all the income that you say you're going to distribute after expenses, we're going to tax you on that. So what do? They look at their fiscal year and they rush and they say, okay, here's ROC. This 70-cent payment, 20 cents is the dividend income taxable, and 50 cents of it is non-taxable. So it is at that moment. That means you pay no ordinary income tax that year. However, what is it? Well, its return of capital goes into, let's say that I bought AMSI and I paid $20 for it. Okay. And I held it 9 months only. And then I sold AMSI and I sold it for $21. Then I got $1 profit. That's ordinary because I didn't keep it long enough for long-term capital gains, right? Which would be like what, 20%, 28%. I can't remember at the moment. But otherwise, it's ordinary income if it's not long-term capital gains, right? Regular capital gains goes right into your income and gets declared. So ROC is a way of taking it out of ordinary income, and only when you sell the stock does it get configured. So that example of having $1 gain, right, from 20 to 21, you would have $1.50 gain if 50 cents of the 70 payment to you was considered ROC. So your cost basis would drop from 20 to 19.50, and thus you sold at 21, you'd have $1.50. But most people, I think, want to stay in these funds. I do. I want to typically, rarely do I trade in and out of them. It's not a bad method to lower your cost, right? Everybody talks about DCA. I mean, but the problem is, unless you're really a good trader, you can also get caught seeing it gap up, thinking, I'm going to wait to buy it later, and something happens and up it goes, right? So I've never seen anybody 100% of the time, just day in and day out or week in and week out, just keep lowering their costs. They lose sometimes. Okay. So what's the net here? So I just picked AMSI. I mean, I could have done it on any of them. And I took the months, okay, from November, because it's the only months that they both paid, right? Because AMSI's been paying a couple more months. And I said, go to their website and get their tax information. That's where I got it from. I didn't make this up, guys. Okay. And they state right there how much of this 3211 is ROC. So it is 76%. And then they tell you that 7.7 cents is the only taxable amount, even though you're getting 32 cents, right? So I did the same thing over here. And there's only two payments where 54% of the payment of 68 cents was actually ROC, return of capital. This one had a nice 71.28, but look over here. 76, 73, a low of 57, 284 is a 68, a 77, right? So even though they only paid 270, 75% of that 270 was return of capital. You only paid taxes on 68 cents a share. That matters, okay? Over here, you had a 20% in effect, right? So it was 720 in all their months. And in this case, all of their months were included in the ROC. But these, I didn't bother to do these two. So they only had 533 worth of eligible money and 20%. Really, I gave them the advantage. I rounded 1969 up to 20%. So $4.28 was taxable, so 105 was not taxable, right? And it was 1969, and I called it 20%. So that matters. So I just wanted you to know that. All right, guys. So let's finish up on why I think that Granite is going to be a good competitor. Okay. So their CEO is Will Ryan. Okay, he's a Brit. Been in America a while now, and very experienced in pioneering creative offerings. Okay, let's even go back up here. And by the way, when you use the analogy to say YieldMax is a king, look at all these funds, they got 100% return, NVIDIA and this. Well, Kurv doesn't do those funds. They probably would have a better total return on some if they did. And I brought that out to Howard Chan in the interview. I said, Howard, are you considering BTC, or is it just, because now BlackRock, everybody and their brother is doing some kind of BTC fund? He said, yeah, Bruce, we're looking at it. And look, he came from PIMCO, and some of his people were Goldman people and everything else, but they're more experts in, fixed income, which by itself tends to be a little more conservative. Hey, they're doing synthetics. I think he told me they were using Neos or someone like that. I didn't really find much, whereas YieldMax and Defiance use Zega, right? And we know Jay's the co-CEO of Zega. So they use somebody to do that. And in fact, Kurv is using somebody to do their synthetics. But they don't own any crypto, and they didn't choose NVIDIA. So that's why they don't have a huge payer. And if they did and their NAV was better, hey, why, or sorry, their total return was better. All right, so look at this 3x MSTR. Okay. There isn't even a 2x yet, but they're coming. I think Rex has announced both a bull and bear 2x on MSTR just recently. I know Defiance is already filed, but I think theirs is a 2x bull, right? To me, I want them both because I'm going to use them when I see that 130 or 125 hit next on BTC. Because they don't, I mean, maybe YieldMax will come out with one, but there are times, and I promised you guys a little bit. So when do you want to be in an inverse fund? If the market is relatively flat, slightly up, 1% a week, 1% down, 1% up, 2%, you start getting 3 and 4% a week in one direction. In other words, the tendency is all of a sudden bullish. You're going to get killed on the opposite fund. Let's make it up. Let's make up the NVIDIA example. Okay, we got dips now and we got NVIDIA. So let's say you think that you're going to be in both, and hey, I'm just going to collect income on both. Wow, this is great. Well, that's great if there's a 3 or 4% change over the next month in either direction. You can go along collecting income. But guess what? The minute one of them takes off, relatively starts getting causes itself to get capped, then it starts underperforming. And then the other one is not performing at all, right? Because it's going the other way. Let's say that NVIDIA really drops, okay? So you're getting killed in NVIDIA, right? Because it's going down. You're better than the underlying, but a small amount. But on dips, you're getting capped because it's running way past on the way down. So don't just assume they're great, right? Without understanding. And you could do a little bit of a ratio, if you're more bullish than you are bearish, to a 70-30. But recognize when you're getting capped on one, get out. It's not necessarily the best play. Okay, so what else? So there's a reasons that I think, Granite will be great. So Will Ryan has a lot of experience. Think about that MSTR 3X fund. It's the most volatile ETF fund in the world, sometimes moving 70% in a day and averaging a staggering 30% daily change. Wow. And Euroland, to be honest, has less restrictions. I remember when I traded precious metals and commodities in the decade of 2000s, and I only found that because I was working in high tech, and a lot of my value and stock and cheap options that I got were worth all this money in 99 and going up, and then in 2000 it crashed, and I'm like, what's going to happen? How can I salvage? I want to retire in a number of years. So I set on the path figuring out what would perform for that decade after the crash in the NASDAQ. and I found commodities. And in particular, I found gold and silver and precious metals. So I know what leverage is. And Drexon, I was doing JNUG and I was doing Nugget and I was doing all these, they were 3Xers at the time. And then I noticed, when I wasn't using them and the run was over, and I started looking at it, I just assumed they were still 3X. No, they were 2X, and they're 2X again now. So there's been some pressure from the SEC to push down and not allow that. But I just saw the other day there's a gold fund, well, gold precious, I think it's GDXU, right? That's a 3X. So I guess I'm not sure if there's a hard and fast rule on it, but you don't see many 3Xs. You see 1Xers and 2Xers, and Granite's got a lot of them. So I think Granite, to me, has a proven track record. They're bigger, right? They got a 6.5 billion assets under management, and YieldMax has 4.5. YieldMax done a great job. It's a great thing. I mean, I pick on them sometimes, but I do think competition would be good for all of us. And don't count out YieldBoost, guys, at all. So where else in these guys? So Granite Shares is 6.5. Sorry, this is on revenues, not but Defiance is 72 by assets under management. Granite's 39. Kurv is way down there at 233. Rex Shares 118. Round Hill 73rd. And YieldMax at 46. So don't discount Granite. Don't discount YieldBoost. But again, the proof's in the pudding. Let's see. Okay. I don't think they're going to go out and do a monthly covered call strategy on their synthetics. I think they'll emulate YieldMax and do weekly. And frankly, I don't think if you do the same thing that YieldMax is based on some of the poor execution, I think it'll be easy to beat them or do as well as them. But we shall see. I'll be the first one to tell you if what they do is bad because I'll be reporting on it whenever I can. Okay, guys, that's what I got for you. Sorry it was a little long in the tooth. But there's a lot of data. There's a lot of important things than just my opinion. Facts don't lie. Okay, guys, this is not financial advice. I'm not a financial advisor. Have a great rest of your weekend. Bye for now.